On this episode, we're going to go over 6 common credit mistakes to avoid. Number 1, missing payments. Payment history is the most important factor when it comes to your credit and accounts for 35% of a FICO score, according to FICO. Missed payments can quickly lead to a subprime credit score and can stay on your credit report for up to 7 years. Making the minimum monthly payment for loans and credit cards keeps these accounts in good standing and prevents late fees. Number 2, not checking your credit. It's important to check your credit report regularly to search for identity theft and fraudulent accounts opened in your name. You can also catch credit reporting errors like inaccurate balances and payments. Potential fraud and reporting errors can negatively impact your credit score until you file a dispute. With a credit monitoring service, you can get instant alerts on late payments, fraudulent activities, credit score changes, and more. Number 3, frequent credit applications. So applying for too many credit cards and loans in a short period is another common credit mistake. Credit applications require hard inquiries that temporarily penalize your credit score and can reduce your approval odds for new accounts. Having too many new accounts can also hurt your credit, as you may no longer qualify for the best loan rates. A longer credit history is more likely to result in a higher score. Number 4, a high credit utilization rate. A high credit utilization rate on revolving accounts, like a credit card, can negatively impact your credit. Carrying a credit card balance can also hurt it, even if you make the minimum monthly payment and keep the account in good standing. Lenders may perceive a borrower with a high credit card balance or large loan balances as more likely to default. Because you got to think about it in the way of like a business, right? If the business kind of sees you not being able, like basically, if you are seen as a higher risk, then they are going to view it as, I don't know if we should really give them a great score because there's just maybe too many factors that might make them not be able to pay their bills, right? And that's the thing. We're like that's why you got to be very careful with your credit utilization. You never want to max out a credit card balance. Like that is one of the worst things that you could do for your credit score. You also definitely don't want to miss any payment times, right? But either way, like basically for the whole credit utilization rate, let's say that you have a credit card with an available balance amount of $10,000. We're going to keep it simple. You should pretty much only use $500 to $1,000 on that card, and you should pay it off immediately, and you'll have a good credit score, right? Because they see like, oh, okay, you're not a risky customer, so that we know that you're going to pay your bills on time all the time. So they know that they don't got to really worry about you actually paying your bills, right? So just keep that in mind. Number 5, closing credit cards. So canceling credit cards that are several years old can be an easy credit mistake to overlook. Having fewer accounts limits the risk of fraud and default, but reduces your total available credit and the length of your credit history. Now, I will say this. I would never suggest someone to get a credit card, but if you have a credit card, I would recommend just basically never really using it, or if you do use it, if you prefer to use that instead of a debit card, basically, if you spend any money on your credit card, immediately pay it off. And I mean immediately. Literally, basically, within 5 minutes of spending money on that credit card, you need to be transferring money to that credit card to pay it off. That's how quickly you need to do it. because a lot of people end up getting to the habit of not doing it and basically being lazy, and you cannot do that when it comes to credit cards. Like you got to immediately pay this stuff off right away. Number 6, early retirement plan distributions. So some people may use retirement funds to pay off high interest debt quickly. This decision can lead to a credit score increase and help avoid short-term financial trouble, but early retirement distributions are subject to penalties and taxes and can result in future stress. So to see where you fit in with your credit score, turn to a credit monitoring service. There's free ones like Credit Karma and others, right? And some banks actually offer you a free credit score check on like a monthly basis, which is pretty nice. I know Bank of America does that. I believe I think Chase might do that as well. But there are some banks out there that will actually give you a FICO credit score for free on like a monthly basis, just to let you know how you're doing. To basically give you like a rough estimate. But here's the thing too, right? A lot of people think that like taking the retirement, like taking the money that they put into like a 401k or to their Roth IRA, and if they like take that money out of it to pay their debt, that's actually a good idea. The only thing is, yeah, you definitely want to pay off your debt, but you don't want to basically pay like 50% in taxes pretty much for nothing, right? Because that's the problem with taking retired money early, is that you basically get taxed a very decent amount plus the fees, which is a super high amount. Then you typically have to pay it back as well, usually, right? Because if you end up doing like a 401k loan, you're going to pay that back. And if you don't pay that back in a certain amount of time, you get double whammied with another amount of fees and all that. So there's a lot of issues with trying to pay off your debt to, technically increase your score because you lower your utilization by taking it out of retirement. Like you don't want to do that. Now that being said, if you have like investments in like a non-retirement account, like let's just say that you have like a Robinhood account for an example, which you can check that out down below in the description. Let's say you have like a Robinhood account and you have like liquid investments in there. Maybe you got like $100,000 in Dogecoin for whatever reason, right? And you want to sell that to pay off your debt. That makes sense, right? It makes sense to pay the fees and the taxes on that to pay off your debt than it does to take out your retirement money, let's say in like a 401k or a Roth IRA or an IRA, and have to pay so many fees, so many taxes, and basically just be screwed over in the long run, right? Because you want your investments to grow very long term, where the government doesn't have their like little filthy hands on your money, right? That's the whole goal of like investing. So you don't want that to ever happen. So if you're trying to pay off your debt and like increase your score and all that kind of stuff, right? Don't take it from retirement investments, but it's okay to do that with like a just a typical brokerage account that you might have or like a money market account that you might have, right? In that case, it makes sense. Go ahead and do that, but definitely not a retirement one. Feel free to become a member, support this in the description, and check out 14bucks.com to master your money. We have personal finance lessons, personal finance courses, and contact us with your personal finance question or story.